Welcome back to our bi-weekly webinar. I'm your host alongside Adebayo Fasanya. We are the co-hosts of the webinar, and today we are bringing back Matt Temple, who is Director of Investment Operations at NH Capital. And we had Matt and Musa on a few months ago to give us a really interesting talk, one of our most unique talks of the year about the CD5 program. But now we're actually bringing Matt back to talk more in depth about NHK, which does all of their development and investments in different multifamily and different commercial spaces. So NHK is an arm of Hogan Companies, which was started 30 years ago. So this is a company with tons of experience. They have dedicated staff with insight of working with approximately 6,000 high net worth clients from all over the world, over 100 countries included. They have $700 million worth of property under management and $130 million of capital, investor capital under management. So this is a really, experienced group. I'm actually one of their investors, along with some of my family members. I'm in a couple of their deals in Dallas that are going very well. And according to the business plan right now. So I'm really excited to bring Matt. I've had plenty of conversations with him one-on-one and love their vision and where they're going. So that's high level. So I want Matt to take it from here, and you can definitely give us a detailed view of NHK, the history, and your role with them.
Yeah, I appreciate the introduction. I'll just go ahead and share my screen. And I'm sorry on the last Zoom call. Actually, can you enable this? There we go. Perfect. The last Zoom call, I was unable to talk about NHK Musa's presentation regarding our company, CMB. Just a lot to take in there, but let's see here, share. Can you guys see my screen now?
Yes.
As you mentioned there, George, yeah, we have extensive experience at NHK that is more than just 2018, 2019. If you look at our website, it looks as if we were actually, NHK was formed as a new kind of private equity arm in 2018 and 19, but like you mentioned, we have over 30 years of experience through what's called the Hogan family companies and CMB, which is our EB5 regional center where we operate an investment program that allows foreign investors to get a green card for creating U.S. jobs through the development of construction. That business has had over $3.3 billion now where we've raised capital, and we've placed this capital in all sorts of type of ground up developments. We got townhomes, single family homes, you got condo towers, a lot of hospitality, a lot of logistics and warehouses, you name it, multifamily, energy. So we've done a lot of developments, and our team has a vast amount of experience in the real estate industry. So if people go to our website, you say, oh, wow, it's 2018, 2019. We're using the same staff from CMB at NHK. So leveraging the relationships from CMB and NHK. And the reason for this is, as he mentioned, we've raised now over $3.3 billion at CMB. The function of that capital goes into the capital stack at a debt level. And it's really the primary goal for that company and that platform is getting the green card. That's the first goal, is green card through the investment. And then the second goal is preserving your capital and then get your capital back once you've completed your immigration process. So it's a different strategy. But through this company, we've had over 6,000 families that are high net worth, that we've built these relationships. They're making decisions to move their family from whatever country they're from to the U.S. for whatever personal reason, whether it's for their kids, for a better education or an opportunity in life. And we've built these relationships. And over time, we've had successful investments. People have gotten their green cards. They've moved to the U.S. They've gotten their capital back. And they're asking, hey, how can we continue this relationship with you? We really built the relationship with some of our case managers that work with those investors. We know their family, we know their hobbies, we know their likes, and they want to continue this relationship. But investing back into real estate, but for a profit or a chance of profit and for preservation of capital. Moving to the US, sometimes people don't have these relationships, nor the time. So what happened is the Hogan family, as you can see here, actually Noreen's not on here, but Noreen Hogan on the left, Kevin Hogan, she is the owner and principal manager of NHK. And the family themselves, they come from a vast amount of money from their previous ventures, CMB being a multi-billion-dollar company, NHK now being a very successful company, Rock Island Auction Company, who Kevin Hogan operates and manages. It's the largest online anti-gun auction in the world. So they're actually going to be opening up a new office in Dallas soon. But they have all these ventures that have created an amount of wealth for them. And they've been doing these real estate investments at the equity level, where they're looking at these developments for a chance of profits and a chance to diversify their investments as an alternative route. Instead of the stock markets and other routes like that, they're looking at real estate. So they've been doing these investments as a family. And the thought was, okay, we have these investors who are asking to join us. Let's create a platform where when we are going to do a deal as a family, we'll do the deal, we'll capitalize on the deal with family money, and then we'll open up this investment for our investor base to join alongside us. And the good thing is, as an example, if we're going to go and fund $10 million in equity to a ground up multifamily construction opportunity, the Hogans fund it. We do all of our securities compliance and offering back into work. And then we open up to our investors for, let's say, 2 to 3 months so they can come and join us. If none of the investors like the offering, maybe it doesn't fit their portfolio, they don't join. The Hogans are in on these deals 100%. We're committed. We already have our agreements in place. So it's not like we need the capital. It's really an exclusive opportunity and group that allows others to invest. So, it's very family oriented, a family office. And I think it provides a lot of reassurance to our investors, knowing that the Hogans themselves, they're invested 100% in, and they have skin in the game in each one. And one thing I'd like to add is, when we do open up these offerings, the Hogans allow us to back down their amount, but no less than they want to have at least 20% of each offering of their own family money in it. No, they don't want to have any less than that. So they want these investments for themselves as well. That's just a little bit of a background of how NHK came to be a company, and how we've actually been able to grow since early 2019 till now to, like you mentioned, about $130 million of cash under management. So again, this says 20 years of experience. This needs updated. We're now actually close to 30 years of experience at CMB, which is the same management staff that works with developers that then also uses those relationships for NHK. Our mission and values have always been the same. We've actually took the same values from CMB. It's take care of the client first, and the client will take care of you. So we always put our client first. And that's always because at CMB, we know that when we're doing these offerings and investments and we're making these deals with developers, we know that we need to have all these agreements in place, because everything's got to be successful. If anything trips up on the CMB side, then that investor's jeopardy of getting their green card and moving to the US is at risk. And we don't want any family to move to the US and then for some reason something go wrong and they get a denial and they have to leave the US. So we always want to put our client first because of this situation at CMB and because it's the right thing to do. And we took these values and we brought this to NHK. One thing is, this is a picture of our JW Marriott when it was under construction. It's downtown Dallas. That's me on the far right, a colleague right next to me. And then we have some investors you can see in the background. We do site tours where if an investor wants to get comfortable with the investment he's going to go into, we'll take the time to, whether he flies in, take him to the site. For example, DPR was the GC on this. They'll let us on the site. They'll give us a tour of the construction. They can see it. So again, taking care of the client, taking care of their needs. And like I said, they'll take care of you. They'll reinvest. They'll trust you. That's what you want in a company. Again, myself, the Director of Investment Operations, we have senior management, again, that are the senior management of CMB, Neil Lee, Matt Hogan, Kai Boyle, and Tara Moffitt, all now senior vice presidents of CMB and NHK. The way that we actually do our deals at NHK is we come in as a majority owners. If we're looking at partnering, let's say on a single family rental community, we look at the deal, we underwrite the deal, and then we obviously are looking at our partner first. Have we worked with them? Yes. We haven't worked with them. What's their past performance? What's some referral reference points, whether it's banks or other partners? What we do is we typically take two types of strategy: an investment with an equity, a straight up equity participation, or we do a debt investment. So a majority of our investments so far have been joint venture common equity investments, and NHK comes in as the majority owner. And the reason why we do this is when we find a deal we like to be majority owner. There's certain provisions in our joint venture agreement with the developers where we have a majority voting power on certain decisions. So it's something that we like. And when we do our due diligence and we like a project, we do like to have a majority of the ownership. These investments obviously are going to be benefiting from if the project gets completed and the underwriting metrics are exceeded, or we sell the property sooner, or we sell it higher. On this strategy, our investments and investors can actually reap that upside. On the debt side, which we've done one, we might provide a pref equity loan or just a mezzanine loan, which is a fixed rate and is strategically positioned in the capital stack to provide some protection, but also to provide that kind of quarterly dividend that some of our investors do prefer over the equity investments, which is typically a lot of capital gains. We do both, but right now we've been focused on more of the equity investment side. As I mentioned, typically our structure is we have our GP, which is NHK. What we do is we form 506C offerings, so accredited investors only. And we go out and get a securities, and we have our outside securities counsel that reviews our documents, our in-house compliance team, our in-house legal team. We create an offering and we go out and we raise the funds as a GP. And the GP actually puts 1% of their own capital in. The Hogans actually come in as an LP. It should be Hogan family more or less over the LP, but the Hogan family comes in as an LP investor. And then we then pool together a bunch of limited partners on a minimum investment of $100,000. This then goes into a limited partnership agreement or a limited partnership LPA. And then that is partnering with the developer and sponsor, which then obviously is going to be the owner of the project. An example is this is a picture of the Luminary. It's downtown Dallas. We partnered with Harwood on this, where we came in as a limited partner on the joint on an agreement, and then they came in as a developer sponsor, and then again owning that project. At NHK, I think he mentioned that we have over 100 now, maybe over 105 different investors from different countries at CMB. At NHK, we've grown to now we are over 20 investors from different countries. So our investor count has actually grown from more than 150. I think we're now above 200. As I might have mentioned before this webinar, talking with George and Bayo, that we've grown a pretty good base of investors in Dallas. We've been doing a lot of our investments within Dallas. So our investor count has grown to be over 200, and unique investments are investments from individuals. So we have investors that have not only invested in our first offering, but they've invested in multiple offerings as they get comfortable with our structure, as they get comfortable and trust our management team. Again, we have now, with our newest offering we just opened, about $130 million in cash under management, and just roughly over $700 million in total transactional value. Tying back again to CMB. So having funded over $3.3 billion in developments, and then combining that with the developers and the lenders, the senior lenders, the capital is north of $7 billion to $10 billion in total transactional value. Through these developments and relationships at CMB over the past 30 years, we've built relationships with some of our most trusted developers, Stillwater Capital being one of those from Dallas, Hillwood, the Pro family from Dallas. We've worked with them now at CMB, over $1 billion we've lent to them and currently have with them right now. Harwood International, they're in Uptown Dallas, the Harwood District. We work with them on many projects at CMB and at NHK. We work with many banks. So we've built these relationships that, we've learned to say, okay, we've had very good experiences with this developer. We're going to look at them as a partner at NHK. We've had experiences with other developers where there's been maybe some changes or some not scares, but we get to problem solve on some of those other projects at CMB. We have a portfolio so large, not everything goes as planned, but we've had other developers where we said, maybe this isn't the greatest developer we'd like to partner with on the equity level at NHK. So we cherry picked the best developers from CMB, and we've actually negotiated our way into being equity partners. And sometimes that takes a little bit of time. They already have their equity relationships, and they were really, or more or less, used to us being a debt source through the CMB platform. Finally getting involved on the equity side, we're building these very trusted relationships, like I said, with Harwood, Stillwater, and then the Sam Moon Group. We did the JW with them, and then some of the banks that we've worked with, Bancorp South, Interbank. I know we've worked with Texas Capital Bank, but we really depend and we leverage our relationships and partnerships. Kind of like a holistic overview of what we try to target. This is a little bit on the conservative side, but if we're looking to pretty much 2x our investors' capital over a 5-year period, and taking kind of our previous 6, 7 investments now and averaging the targets, right now looking at our investments, our average targets when collectively combining them have been targeting about a 17.5% IRR, about a 1.7 equity multiple, and this is over 4 years. So each investment has different strategies, different risks, different locations, different asset class. But when you collectively combine them, this is our overall average targets. Looking into our actual performed projects. So we actually opened up, it's called the Augusta Flats, and it was our first project at NHK that we partnered with Stillwater on. A developer, we've done 10 to 12 previous developments at CMB. We came in as majority owners on this, with Stillwater being the developer and partner. And this was a multifamily garden wrap style in San Antonio, Texas. This was actually targeted, as you can see on this last slide, to be about a 12.4 IRR and a 1.5x equity multiple over a 5-year term. So this was our first investment. We wanted to be extremely conservative to our investors as we roll out our platform. The saying, under promise, overperform. You don't want to over promise and underperform. That just never looks good. This was our projections for this project. We actually sold this in late 2021 in December, and we achieved for our investors about a 26 to 29% IRR, and then a 1.59 equity multiple in 32 months, in nearly half the investment periods. Our very first NHK actual on the platform investment was very successful. And this is something that the Hogans have experienced as a family with some of their investments before we opened up the NHK platform. So this is an actual investment, which anyone is wanting to learn more about this, I can go into. But again, this was a multifamily in San Antonio. It was 262 units. And the developer Stillwater was able to complete this project, start leasing it up, and then sell it within 32 months. So a phenomenal turnaround period for the investors. Another past project of ours, just to give you guys an idea of what NHK has done, is the JW Marriott in downtown Dallas. So this was actually our one debt offering. As I mentioned, we've done equity and debt offerings. And this was a debt offering. And originally it was going to be an equity offering. To give you a little background on this, we were looking at partnering with the Sam Moon Group on the JW Marriott. This was just before COVID. We were negotiating our JVA, negotiating the senior lender. The market in Dallas needed a high-end luxury hotel. There just wasn't a lot of high-end luxury hotels in Dallas. If there were, like the Ritz, they're outdated. So they needed some new product. And to know that there's not a JW in Dallas was like mind-blowing to us. So the Sam Moon Group had a relationship with Marriott, and we're able to get them to secure this flag and the development. And we were getting ready to capitalize and close on the loan. COVID hit. And we all took a step back as a partner and as the lender, and we all took a step back. Okay, what's going on here? And we reanalyzed, we talked it through. And at the time we thought, okay, COVID's maybe just a temporary thing. Fast forward now, it wasn't temporary. But nonetheless, we, instead of being an equity partner, we repositioned and decided to do a pref equity loan to the developer, which kind of further protected our position because it gave us reassurance and certain guarantees. Whereas equity, obviously, you're in there through the ups and the downs. And we capitalized on this and moved forward during COVID, at the beginning of COVID. And luckily enough, a lot of developments at that time and thereafter never got capitalized, never closed. So our JW actually was able to move forward through construction and has now been completed and is open. And this project has been extremely successful. Actually, we just had our grand opening just a few weeks ago. It was absolutely beautiful. We were projecting a high 300 ADR, and it's actually hitting high fives, low six. So the project's doing phenomenal. That investment that we structured was very unique. We basically had an interest, pref interest that was paid quarterly to us. And then once this project is realized and they want to refinance or sell, we have this back end target IRR achievement hurdle that they have to target to take us out. So we're extremely happy with this debt project. But again, it shows our diversity and our vision going from a multifamily to a JW Marriott, and in this market just welcoming this development just recently. And then, as George mentioned, we've done some single family rental, I think, which him and his family have taken part in some of these, but we call this our SFR series. So we did 3 single family rental community developments in DFW, one in northern DFW, McKinney, and then southern DFW, Mansfield, and then back in northern DFW, Frisco. And when we were looking at this asset class, which is a fairly new asset class, BTR, build to rent, SFR, was very new asset class. There wasn't a lot of comp sales data, but there was really good comp lease data. And looking at the fundamentals of the market during COVID, obviously you saw people that wanted to leave the downtown areas, maybe escape and move to the suburbs, have a little privacy, a little space. They don't have shared walls or shared ceilings. They have their own home, willing to pay that premium. We saw this trend from COVID. And not only that, you had the trend where during COVID, everyone throughout a macro level saw the price of homes skyrocket. Just the unbelievable value appreciation during COVID. And it made the affordability of purchasing a home more unattractive for some of the would-be first-time home buyers now having to rent. So we saw this move to where people were going to these more high-end submarkets like McKinney, Mansfield, and Frisco. And we capitalize on these SFRs all throughout DFW. So again, this is our single-family rental in McKinney, which is going vertical right now. We did the Reserve, which is in Mansfield, Texas, southern DFW. This is actually going to be a unit mix of some townhomes and then single family homes. So a little bit more mixed units gives that variety if we want maybe a cheaper price point or if someone's looking for that privacy. This one is actually also going vertical as well. And then we capitalize on the Link, which is in Frisco. This one's moving through horizontal construction and will be going vertical early, I believe, next year. This one I think is very interesting because it's in Frisco, but it's right next to the PGA golf course. So PGA relocated up from Florida to Frisco. Stillwater master planned the PGA kind of build out with their headquarters, the Omni Resort and Hotel, the Frisco ISD, which is the school district, which built out a high school and a middle school. And then in addition to this massive build out, they have phase 2, which is going to be multifamily, some hospitality, some office space. But in phase 1, this SFR was a part of that, and we were able to come in and lock in this development. And there's been great fundamental increases in just the rental pricing in the surrounding area with big developments called the Fields that's going to be right next to us. You have an amusement park that's going to be just down the road from us, breaking ground, which I think was a controversy issue, but received full approvals and will be just not even a mile from our site. So this just also gives you a little bit of a background of some of our past projects. And then again, we don't have just one specific asset class we focus on. We want to always be looking at different markets, different asset classes, different trends. And then after those SFRs became hard to really lock in a deal because the prices of the interest rates were skyrocketing at such a high rate and quickly that it was hard to forecast. And senior lenders were really just pins up. And we thought, okay, the prices of interest rates going up, is it a good time to develop? Is it even possible to get a capital stack together and close? And we saw an opportunity at that time to actually come in and purchase properties, value add properties. So this one was an existing office building. It's called the Luminary in downtown Dallas. The project had some issues with stabilization. It was about 67% pre, it was our leased. The current owner at the time couldn't get it fully leased, and they wanted to liquidate some of their office space. We saw this as an opportunity to come in and buy this distressed office building. It's a newer build, just recently completed, I think in 2018-19, and come in with a good partner, Harwood, and then lease up the space, stabilize it, and then get through this downturn period, and then find a buyer once the capital markets improve, which we're anticipating hopefully to be sometime in 2024. But about 3 months after acquiring this office space, Harwood and their team did a phenomenal job, and they've actually executed 2 lease agreements, 3 lease agreements actually, that now brought this building to 100% lease and occupancies. This project with the current lender on it, it's actually generating positive cash flow right now. And the average lease term right now on the property is just over 10 years. So we're hoping that as the capital markets improve, we see some pullback from the feds. We'll see some institutional buyers coming back into the market, and we're going to look to come and sell this property, hopefully at a much higher valuation than we bought it at sometime in 2024. Again, different strategies, not always ground up construction. We do look at light value add. We have been looking at light value add for multifamily. We have been looking for about 1.5 years. But we just don't see that asset class distressed enough and the price points coming down enough yet for us to come in and see that value add appreciation. We're still looking, and that could be maybe a potential future strategy from NHK. But yeah, this was one of our previous projects, the Luminary. Just recently, which is actually still our current investment at NHK. Again, totally different from the JW Marriott, our multifamily, our SFRs, and then the value add acquisition of the Luminary. This is actually a development in Allen, Texas, which is again a northern DFW market. And it is going to be a light industrial technology manufacturing park. And it's 7 buildings, and it's 2-phased. So phase 1 consisting of the first 4, and phase 2 consisting of the last 3. And we're splitting them up so we can capitalize on 1, complete it, sell it to an institutional buyer, and then roll the equity into phase 2, complete the remaining 3 buildings, lease it up, sell it. So it has a little bit different strategy than our other SFRs. But again, we think this was a phenomenal asset class and still is an opportunity in DFW. During COVID, there was a lot of exposure with supply chain, and that's what was maybe an influence on the inflation rates going up, not being able to get product onshore, a lot of manufacturers being offshore. So there's been a movement, obviously risk kind of analysis from some of these technology manufacturers, whether it's medical devices or just technology devices or fiber optic devices, bringing that, or chip manufacturing being the biggest one, bringing that onshore or near shore the US because of the risks that we saw. They have the Chips and Science Act, which is another huge influence that is creating benefits for corporations that are looking to build and start to construct these factories to build chip manufacturers back in the US. So there's a lot of influence from some of these funding Chips and Science Acts, similar to that. But not only that, DFW is, and all of Texas is very business friendly, having no state tax. And a lot of companies have been relocating from California, from Illinois, other states to this area. And Allen was a great market because of its talent pool that's attracting some of these manufacturers to the area. And it's what we consider a manufacturing boom right now in the US, more importantly, also in Texas. So we saw this trend. We capitalized on this deal in May, and then we've since broke ground and have already secured a lease for one of the buildings very quickly at much higher underwriting rates than we anticipated. Out of the gate on this one, we just finished pouring the slabs for all of the 4 buildings. We'll be going vertical soon, but the fundamentals on the lease rates and the lease terms has been just extremely received and has exceeded our expectations. Again, another strategy that we take on at NHK. We're not just fixated on one asset class or one location. And really quickly, at CMB, we've actually funded over $800 million into warehouses and logistics. So we have a good experience at our other platform in this exact kind of asset class. And we've had almost a near perfect execution rate on the business plan for all those construction, them not missing any interest payments, and them being able to sell and liquidate these properties by the maturity date. So we really wanted to have this asset class in NHK, and this has been our first one. But this is still open. There's very limited availability. It'll probably close here shortly. And we just opened up our newest investment, which actually will be in Houston. It's a build to rent property, and it's taking our SFR kind of fundamental analysis and now being further bolstered. You had at this time COVID having people relocate to the suburbs. You had the escalating home prices pricing out would-be first-time home buyers into renters. So the strategy was very strong back then. It's now bolstered even more due to not only the high cost of homes, but now the high cost of debt to purchase home. Mortgage rates being well above 7% now. So this is a new strategy that we saw in Houston that we're actually going to be opening up soon. And that's really my high-level overview of NHK. Just quickly to give you guys details, our investors, we accept not only U.S. investors, but also foreign investors. As you guys seen, we have over 20 investors from different countries. As a U.S. investor, you have to know that you have to be an accredited investor. And by accredited, you have to have income as an individual of over 200,000, or if you have a spouse, combined 300,000, or you can go another route, which is having a net worth over $1 million. You have to have one or the other to qualify to be able to invest into our offerings due to the 506C regulation. One quick route for investors that may not want to provide their income information, or they may not want to provide their net worth information, they can actually secure a third-party verification report from their CPA testing that, yes, they are accredited. So these investments are for accredited investors in the U.S. And for foreign investors, there's no accreditation requirement. It's more just anti-money laundering security background check on those investors. But yeah, that's just a high-level overview of how who we can accept as investors and the restrictions on certain different types of investors. And lastly, individuals in the U.S., they can, or even foreign, they can invest as an individual themselves. They can invest as an LLC, an entity. They can invest in some of our offerings. We structure them where we can actually accept solo self-directed 401k, so self-directed investments from their IRAs. So there's many ways that people can invest into these offerings. Just if you're in the U.S., you have to be accredited. That's really my high-level kind of overview of NHK, who we are, some of our past projects, strategies. If there's any questions, definitely would love to answer some of those.
Thanks a lot, Matt. That was definitely a great insight into what NHK is doing. It's really impressive. I have some questions, and I invited folks to leave questions in the chat. You can also come off mute, come on camera, and ask your question as well. But I wanted to lead things off by going back to when you mentioned NHK also operates on the debt side.
Yeah.
Investing in mezzanine debt, do you guys actually come in as mezzanine debt or kind of the senior debt?
So we, on that JW investment, we came in as prep debt. We didn't have any lien or rights on the property, but we had really good guarantor reporting. So looking at the Sam Moon Group, we saw obviously their net worth, and it was a pref equity loan to the Sam Moon Group with some security interest in the cash flows of the project. So we do get very unique with how we structure some of our debt solutions. But that one, again, was a pref equity loan to the developer, not to the property. But we do get certain carve out, like I said, that security interest in the cash flows. So we know that, hey, they can't just project us successful, but some reason they don't want to repay us on their pref side. We can have interest in the cash flows from the project. That was a very unique structure, and our investors like that. So our investors throughout COVID have been receiving their quarterly dividends of about 11%, 10 to 11%. And basically that investment, once it's realized, those investors get a takeout IRR back in bonus, which is taking them up to a 17% IRR. It's the only way that our membership interest, which is the pref equity loan, can actually be purchased out of the structure. So it's very unique, but we stay in that structure until we get purchased out at the takeout levels. It's very expensive debt. And it was the only reason why probably it was capitalized on at the time was because the uncertainty in the market and with the capital market kind of freezing, because that was just when COVID hit. But on our mezzanine side, if we do a mezzanine loan, that would be with some kind of intercreditor agreement with the senior lender. So we'd have certain rights and remedies in case for some reason something goes wrong with the senior loan, we can step up and take care of those. But we would also have second lien on the property, and then obviously some carve out guarantees with the borrower themselves. We haven't done a mezzanine position yet at NHK, but it's something that we've actually, it's been what we do at CMB. And we've done a lot of mezzanine loans at CMB. It's our typical structure at CMB. We are now looking at doing senior loans, but at NHK, I don't know if we'll ever be at a senior position. I just don't think that's our strategy.
Thanks. I just wanted to clarify that. A lot of terminology that a lot of us are still learning and understanding. Appreciate that.
Yeah.
Chat.
So it's interesting you asked that question though, because I'm seeing more and more real estate syndication company starting a debt fund.
Mm-hmm.
And I'm starting to think some of them are starting it either to take advantage of the economic condition in which many operators and syndicators are failing and they're coming in to rescue, but at a higher rate, right?
Mm-hmm.
Or they themselves need more capital. And then using that debt fund to, I don't know, use it to loan themselves in a way. I see it pop up more. Like everybody has a debt fund on the side now.
Commercial lending it's drying up, and it has dried up. A lot of lenders are pin up and the rates are high. If you don't have the relationships as a borrower or developer, it's going to be very hard. So it's created a pretty good opportunity for private lenders. For example, at CMB, we are always typically a mezzanine lender, and we have intercreditor with the senior. But because of the way the markets have been and how we want to obviously further position our investment with additional security, having the first lien, we've been able to actually do senior loans at CMB now. And this is providing our investors with obviously better collateral at the senior position. And we're getting really good deals that we're actually being able to come in as a senior lender on. It's a unique opportunity right now, I think, for private lenders, debt funds, to really come in and be a senior lender on some of these premier projects. Whereas probably before, if someone was securing a private loan or a debt fund, because it's a little bit more expensive back then, maybe it's because senior lenders, even when they were writing, that was maybe a riskier project, right? Now, just because senior lenders are pinned down, they're not writing or doing terms. These developers, if they want to move forward, the private loans are actually almost closer to the rate of what would be commercial. So they're able to come in now and play a pretty good role in some of these developments and secure very sound developments right now. So it's funny you mentioned that you're seeing some syndicators do that. It definitely makes sense.
Well,
Also had a question about kind of the range, the scope of different projects you guys do.
Mm-hmm.
Specifically asking about kind of the expertise, the familiarity level of NHK Group within those different asset classes. It's something that we look at as limited partners. We want to make sure the operators have that experience, have that know-how. Could you speak to that?
Yeah, definitely. I wish I had right now available like our past project brochure at CMB. Just going through that would show the experience, but that's why we have such a big team and why we are in different markets. A lot of investors that are limited partners, they either have a full-time job, and even if you're like yourself, you have a full-time job, George, and you're also very good at the real estate side, so you have time and the knowledge to go out and secure your own deals. But many people, they don't have either the time or knowledge to go out and find their own real estate investment. And if they do, maybe they're just very confined to one area, which limits their abilities. This is why we have so many investors that depend on us. They want to be passive. They don't want to have a day off where they're getting a phone call from their property manager or from their tenant, and they have to leave their kids' event. So they don't have to be professionals in the market to know this, but they can depend on us. So we have Neil Lee, who is our senior vice president of finance. He's worked in the real estate industry, pretty much his entire life. He worked for a foreign company before CNB, where he managed a very large portfolio. We have Roshan. So we have a team of, I think, over 10 people on the project side that underwrites. Myself, I would say I more specialize and look at multifamily, single family, and even some industrial and logistics. Whereas when it comes to maybe the hospitality, we have different underwriters below us where I'll send a junior level position. Hey, can you please provide me a report, pull some comps, use some of these third parties, give me a good analytic data on this asset class, this location. It doesn't have to be Dallas. It doesn't have to be Houston. It can be Colorado Springs. It can be Nashville, Tennessee. It can be Arizona. We have teams below us where we have the entry level underwriters that will actually go out, pull the reports, bring it to the main underwriters, so the deal sourcers, and we then analyze that as a team. And the way we go through our investment kind of strategy is we go through that process with our team, and then we have our investment committee at NHK. We bring maybe 1, 2, 3 different deals to this investment committee. And we have Neil Lee, who's obviously doing this forever, and Matt Hogan, Tara Moffitt, and then some of the other senior vice presidents, which they look at the deal from a legal standpoint, a risk standpoint, and then obviously I myself or Roshan or Jane or Chase will actually present this to our NHK committee, investment committee, as underwriting the fundamental of the project. And that's when some deals are then cut, or they're then, hey, this one sounds good, we move it forward. From there, the Hogan family then has their own committee. So it's like a 2-level committee process, where then at that point, from a legal standpoint, from a risk standpoint, we then have to go to the Hogan family as an NHK and present to them. And they then ask us a lot of questions because, as I mentioned, when we are moving forward on these investments, when they say yes, we're signing all of our joint venture agreements, our development service agreements, all the documents that require us to move forward. And that's committing us to the full equity amount. The Hogans know that. They're committed for the full amount. So it goes through like a 2-level process. And then from there, once they approve it, then we then run it to our investors. So if our investors, for some reason, don't understand it or don't like the investment, the Hogans are in. A great example is the Luminary. A lot of retail investors, they can relate with single family, they can relate with multifamily, maybe even retail, but it was hard for them to relate towards the office space during COVID, post-COVID. You see in the news, office space is bad. So we didn't get a tremendous amount of participation from our investors in the Luminary. So the Hogans themselves are over 50% of the actual investment in the Luminary. It should provide a little reinsurance that the Hogans are all in on this, even if it's not well received by our investor base. But we have obviously a big group of underwriters that are at, below myself, Roshan, Neil, Matt Hogan, Jane. Now we brought in a new senior position, Matthew Kaufman. A lot of Matthews, Matthew Me, Temple, Matthew Hogan, and Matthew Kaufman. And then below us, we have our kind of underwriters that will actually go and pull the reports. And if we need additional analysis on, hey, the comp sales, can you provide further analysis on that? Can you maybe pull a little bit further? Can you confine that analysis, maybe 20 miles more in internal radius? So we have the internal teams that do that.
Yeah, thank you for sharing that. That kind of sheds light on the process, the amount of experienced eyes that are looking at the deals and what actually passes through to an investor. Appreciate you shedding that light.
Yeah, if you don't mind, I can give you a quick background of how we did this. So when we looked at the technology park, and Allen's a very dense residential kind of community. It's a smaller city. It's got 1 zip code within Dallas, and it's very dense and residential. And when we looked at it, we liked the area. The area it's a high entry barrier area because there's not much undeveloped land left that's not landlocked. So we liked the area, but we were like, is this the best use of land when working with the developer? And what happened is we actually were invited and we went and met with the Allen EDC, which is their Economic Development Corporation. And they're the city managers. And we sat down with the EDC, we sat down with Stillwater, and we liked the deal, but we wanted to understand, why is this entitled light industrial technology? Why is this not maybe multifamily or not single family? And the EDC walked us through the reason why. And the reason why was they had zero space for new companies wanting to relocate to Allen within their city limits. So they had companies that were wanting to bring their operation, their manufacturing operations within their city limits, which creates sales revenue, tax revenue to the city. And they liked this. So when they were calling the city, hey, my name is XYZ manufacturer from Illinois, I wanted to relocate down to DFW. I'm looking into Allen. I think it's a great labor pool where I can hire there. What can you guys do to incentivize, our relocation? What can you do to introduce us to some product where we can actually position our build out within this building? They had zero buildings and zero individuals to introduce them to within Allen. And they had to then say, hey, unfortunately, we don't have anywhere to send you. Here's the city of Frisco's contact. Here's McKinney. And basically, they gave us a list of over 22 companies in the last 12 months that had inquired, wanting to relocate there, and over 4 million square footage of space. So we knew the demand was there, but there was no supply. So the city, when working with Stillwater, made this a priority to be light industrial manufacturing, and they had to go and get HOA approvals, which took 3 to 4 meetings for these communities, which are right next door, to allow for this type of development next to them. Sometimes it'd be a sore eye to see industrial. Through those workouts, the city required enhanced landscaping, maybe longer, deeper landscaping from the road, enhanced exterior facade, enhanced windows to make it look more like Class A office in a way, to not make it so much as an industrial sore eye. Learning more about this, meeting with the city, it made us understand, us questioning, is this best use of land? And they clearly answer that. We do go above and beyond just the underwriting, and when we do see something that kind of, trips us up, is this right? We do take these certain actions, and for this one, it was well explained by the city, well explained by Stillwater, and we've now, when we closed on it, the city of Allen gave all the permit day one. Take it, you guys need to start construction now because of the demand. And like I said, we have a lease already finalized with the tenant for one of the buildings. Fundamentals and the lease terms are extremely high. We do this as a team. I flew down to Dallas because I'm from our Illinois office just to meet them, to do this meeting and to do our due diligence on this.
Awesome.
Yeah.
Okay, I'll check the chat.
Yeah. So just one last question. So just in ballpark, where do you think the market is going, let's say in the next 2 years? Because the way I'm seeing it now, even though in my area, it doesn't seem like it's that way. It looks like the commercial space is going down overall. And then, like even self-storage is down, which is surprising overall. And now just to multifamily, light value add, like you said, and development is what I'm seeing. So what's your take?
Yeah, I think there is obviously a lot of hesitancy in the ground up construction just because of the unknown direction of the Fed. But there is just a lot of tightening right now throughout just across the board in the everyday person's pocket. You're seeing an effect every day. So commercial is, I would say, probably right now, probably at a standstill. And so is just a lot of the lending. And what we're seeing, especially why we're so bullish on BTR and SFR, is there's been no correction to the housing supply. This housing supply has been shadowing the demand and the need for the shortage of housing. So since 2009, you've not fixed this issue. And we've seen other issues throughout this time that have created even more of a bottleneck. For one, COVID-19. For two, during COVID, the escalating price of wood and construction, people halted for a second. And now you're having even a more issue with people, capitalizing on new developments and building new homes and building new BTR or multifamily. It's creating more of a bottleneck on what we think is the required units for our growth. So we see that we can find a good development partner and we can get a loan that's reasonable with good terms. We think that right now it's a great time to be in this SFR and BTR product right now. We just think that through the construction of our construction loan, which is going to be usually a 2-year construction period, heading out of that 2-year period, we should see market conditions improve dramatically from where they are now. Hopefully a pretty steep reversal by then from the Feds.
We all hope so.
Yeah.
Because the problem is if it doesn't happen, right? We've had percent in the past, right? 15%. It's, I don't know. But most people think by 2025, we should start seeing some reversal at the latest.
Right. There's obviously unknowns. We're just looking at certain asset classes that we think could weather a longer period with longer rates. We look at obviously our tests. We look at certain provisions in the senior loans. We look at obviously our debt reserves. So when we capitalize on a deal, we want to make sure that within the capital stack, we have plenty of reserves and interest reserve that can get us through the construction and through stabilization. Not only that, our current deal right now, which I think I can just quickly pull up really quick, just very briefly, our next deal is actually in Houston, and it's going to be in Conroe, Texas. And it's going to be a BTR, smaller community. It's going to be 108 units, and it's going to be a quicker construction period. But for this one, we got even more unique, providing protection on obviously costs going up. This is a new developer that they're from actually Houston. There's 3 developers that partnered and created Excelsior. And this Excelsior group was collectively created for this special BTR SFR asset class. Previously, they've done other multifamily, senior housing, student housing throughout Houston and other locations as well. So they have good experience. But what we did within our joint venture, in order to protect even further than the normal, developers typically get developer fees. Typically, we can negotiate their developer fee down from 5 to 4 to 3, 3.5. We just don't want them to get too much money off the developer fee where their interest isn't really in the back end. So for this one, we had provisions that if the costs require any increased allocations or capital calls, that if for some reason the costs do go above and beyond expectations, before a capital call, they actually would start to lose their developer fee to 0 before that capital call is created. It makes any cost increase very, very impactful to the developer. This one, we were able to do certain things that we've not done in the past that probably wouldn't be normal, but because of the environment, we are very bullish on BTR SFR, but we also want to be hesitant to moving in, looking at the senior loan, looking at what if analysis, what if costs do go up. We've added in these additional protections, like I just mentioned, that we typically would, just to give you a little idea of what we do when we're navigating through a little bit of an uncertain environment right now.
Yep.
Awesome.
Thank you. Yep.
Well, Matt, we appreciate this. This was good information, getting to know NHK a little bit better. We are at the top of the hour, and I don't know if there's no more questions or no questions in the chat. How can folks reach you? I think you left up a slide up there, but I wanted to give you a sign off here and a chance to let folks know how they can reach you if they had any more questions.
Yeah, you can reach us at nhkcapitalpartners.com through our info account. And then I can just, in this chat, maybe just quickly put in my email really quick here.
Perfect. We do have our next webinar coming up in 2 weeks, so stay tuned for the information on that. And Matt, I want to thank you again. Bio, any final words?
No, just thank you.
Yeah.
Thanks for coming back again, because I know.
Yeah, absolutely.
Yeah.
The first ones. I wonder if we can put it together somehow, but thank you for coming.
Really quick, I'd like to add, as we roll out the deal, we actually are going to have a in-person on-site tour on the 15th and 16th, or actually really quick, the 12th and 13th. So it's the 12th is a Thursday, the 13th is a Friday, and that's going to be in Conroe in Houston. So we're actually going to bring a team in. We bring in our investors, we invite them. to have a kickoff site tour. If anyone wants to meet us in person, I can send this kind of invitation, which you can RSVP to George and Dr. Bayo, and you guys can send those out to your guys' group if you would like. But they can join our site tours and they can meet us for dinner or lunch. But we will be in Houston. I'm not sure where people are located in your investor base, but that might be a good way if they're looking at this, they can meet us in person, see the site, hear about us, ask questions directly. But just wanted to quickly let you guys know that's in 2 weeks from now.
Appreciate that. Yeah, it's always best to try to meet in person, shake hands. So thank you for that. Appreciate it.
Yeah.
Thank you.
Well, I appreciate you guys letting me join, and look forward to maybe a webinar in the future. And any questions that you guys have or any investors or clients have, we'd love to just answer them, jump on a Zoom call if need be.
Will do.
Okay.
All right. Thank you, everyone. Everyone have a great rest of your weekend, and we'll see you in 2 weeks.